For distressed companies with tax-qualified defined contribution plans, such as 401k plans and ESOPs, cost-saving measures may be available. There are also fiduciary issues that should be on the radar for these plans, and compliance and non-discrimination testing are ongoing requirements. Cost savings for a 401k plan might include discontinuing employer matching contributions and profit-sharing contributions, but there may be limitations on this due to the existing plan design, and of course, taking away employer contributions would be a disincentive for employees. On the other hand, terminating a 401k plan entirely would not result in any additional cost savings, at least not in the near term, since plan administration expenses will continue until the plan is fully liquidated. But companies should monitor whether a partial plan termination is triggered, which generally occurs when there's a decline in participants of 20% or more due to the termination of employment, which would require full vesting of the affected participants' accounts. A key fiduciary concern for ESOP companies is the duty of prudence in continuing to invest the plan in company stock at a time when the fiduciaries know or should know of circumstances adversely affecting the stock's suitability as a retirement investment. This would also be a concern for fiduciaries of 401k plans that offer company stock as an investment. And for those fiduciaries who are also officers of the company, it's important to distinguish and document when they're acting on behalf of the company and when they're acting as a fiduciary of the plan. Guidance from ERISA counsel is often needed to avoid these conflicts. Plan fiduciaries should also bear in mind the exposure they may have not only to the IRS and to the Department of Labor, but also to class action lawsuits brought on behalf of plan participants, which we've seen in so-called stock drop cases. Also for ESOP companies, it's generally advisable to involve the ESOP trustee early on in a transaction. The trustee will act as the shareholder with respect to the company's stock held by the ESOP. The trustee will likely engage its own counsel for the transaction, and the trustee will have input on the terms of the transaction. Incidentally, if the ESOP has an internal trustee, that is, a trustee who's also an officer or an employee of the company, consider engaging an independent professional ESOP trustee for any sale of the company or wind down of the ESOP. Finally, for all tax-qualified plans, don't lose sight of the standard compliance requirements. For example, some financially distressed companies slip on making timely 401k contributions, or 401k loan administration, or non-discrimination testing corrections. These types of errors can be a speed bump in a bankruptcy proceeding or in a transaction, and a more costly headache if left unaddressed.